The most dangerous trade in the stock market may not begin with a chart, a news headline, or a market opportunity. It may begin with a feeling, I need to get my money back. And that single sentence can quietly transform a trading decision into an emotional battle. You lose money, the mind wants recovery, you lose again, the mind wants acceleration, and suddenly the objective is no longer to understand the market, but to defeat it. This is revenge trading, and its deepest danger is not simply that one bad trade can lose money. It is that a loss can change the decision-making system itself. That distinction matters, because markets do not know that you are trying to recover a previous loss. They do not owe you a reversal. They do not remember your entry price. They do not recognize your frustration. Yet the human brain naturally searches for closure. After a loss, an unfinished financial story can feel psychologically uncomfortable, and the trader may begin treating the next position as an opportunity to erase the previous pain. The chart remains the same market, the person looking at it is no longer making the same kind of decision. This is where revenge trading becomes more sophisticated than simply trading emotionally. The real mechanism is a shift in the reference point. Before the loss, the question might be, does this opportunity make sense under my rules? After the loss, the question quietly becomes, can this trade recover what I just lost? Those questions sound similar, but they produce completely different behavior. The first evaluates probability and risk. The second evaluates emotional recovery. Once the second question takes control, position size, timing, patience, and risk tolerance can all become distorted. And there is a mathematical trap hidden inside the emotion. A loss changes the capital base from which future gains must work. If an account falls substantially, the percentage gain required to return to the starting level becomes larger than the percentage loss that created the damage. That asymmetry means desperation is particularly dangerous. The more urgently someone needs a large recovery, the more tempting it becomes to seek unusually large outcomes. But seeking larger outcomes often means accepting greater uncertainty, greater leverage, greater concentration, or more frequent trading. The attempt to repair damage can therefore create the conditions for additional damage. Notice the contradiction. The desire to recover quickly can make recovery less likely. Why? Because good decision making in markets is generally built around process rather than emotional outcome. A sound process accepts that individual trades can fail even when the underlying reasoning was reasonable. Revenge trading struggles with that reality because it interprets a loss as something that must immediately be corrected. The trader stops thinking in distributions and starts thinking in narratives. I was wrong, so now I have to prove myself right. The market becomes an opponent, and every subsequent trade becomes part of an argument. That psychological transition is crucial. Trading requires uncertainty tolerance. Revenge trading often replaces uncertainty tolerance with certainty seeking. Instead of accepting that the next outcome is unknown, the mind searches for a trade that feels powerful enough to compensate for the previous disappointment. This is why impulsive entries often appear after losses. The emotional objective is immediate relief, while the financial objective requires disciplined probability management. The same pattern appears outside markets. Imagine losing money in a business and then spending aggressively because you desperately want the business to feel successful again. Or making a mistake at work and rushing into another decision simply to prove competence. The structure is identical. A previous outcome begins controlling the next decision. Finance merely makes the consequences visible in numbers. There is another hidden layer. Revenge trading can gradually train the brain to associate trading with emotional recovery. A profitable trade following a painful loss may produce intense relief, not merely financial satisfaction. That relief can reinforce the behavior. The lesson the mind may accidentally learn is, when I feel bad, trading can make me feel better. At that point, the problem is no longer only risk management. It has become behavioral conditioning. This is why rules matter more after a loss than after a win. A rule is not merely a technical restriction, it is a pre-commitment made before emotion becomes loud. Position limits, predefined risk parameters, waiting periods, trade frequency limits, and written reasons for entering a position can function as barriers between emotional impulse and financial action. None guarantees a profitable outcome. Their purpose is different. They can help prevent one emotional event from rewriting the entire decision process. And there is an important philosophical connection here. The Bhagavad Gita repeatedly explores the difficulty of acting without becoming psychologically enslaved to the immediate result. In a financial context, that does not mean ignoring outcomes or pretending losses do not matter. It means separating the quality of the action from the emotional demand for immediate reward. That is where the symbolism of Lord Hanuman becomes relevant. Discipline, courage, humility, service, and self-mastery are not qualities of uncontrolled force. They represent strength under direction. The strongest trader, therefore, is not necessarily the person who can take the biggest position after a loss. It may be the person capable of doing something far less dramatic, stopping, observing, accepting that the previous trade is finished, refusing to make the next decision simply because the previous decision hurt. Because a market loss has already happened, it belongs to the past. The next trade does not owe the previous trade anything. That may be the deepest lesson of revenge trading. Your next decision should not be a hostage to your last result. A loss can provide information, but it should not automatically become an emotional command. The market will continue producing uncertainty whether you are angry, confident, fearful, or calm. What changes is the quality of the decisions you make while facing that uncertainty. So when the urge to win it back appears, the most important question may not be, where can I recover this money? It may be, would I make this exact decision if the previous trade had never happened? If the answer changes, something important has changed, not necessarily the market, but the decision maker. And perhaps that is where real financial self-mastery begins, not with defeating the market, but with refusing to let a temporary loss dictate the architecture of the next decision. Jai Hanuman.